episode of Equity Mates. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Excited for the final Tuesday of the year for us. I think that's just going to be a trope that we roll out all week. But in celebration of what's been a great year here for us at AusBiz, we've got one of our favourite guests returning for a long-form interview. Yesterday, we spoke about all things inflation, and today we're going to speak about some of the things he's learnt from the recent AGM season. So excited to get stuck into this one.
Well, yes, it is our pleasure to welcome back Roger Montgomery. Roger, welcome.
Thanks, Bryce. Thanks, Red. Good to be with you both.
So we want to discuss some of the key...
I haven't changed since yesterday.
Neither have I.
Neither have we.
We've been waiting in the studio.
I've waited 24 hours. I've been sitting here waiting for you to come back on.
Busted. We've made it all year, Roger, and you've just pulled the curtain back. But no. So yes, look, we want to talk to you about AGM season and some of the key takeaways that you've taken from it. So, let's start at the top. Expectations, have they been better than expected, worse than expected? What's been your sort of key takeaway on that front?
I think generally, both in the US and in Australia, generally speaking, for the companies we look at, better than expected. Companies are continuing to, increase their optimism about FY22. They did call out, particularly the retailers, they did call out some tightness on margins as a consequence of rising wages in some sectors of the economy, and also because of the supply chain bottlenecks that everyone knows about. That has caused, that's caused some difficulties, not only with price increases, but also just with supply of stock. And so the companies that have emerged stronger have been those that were forced during the lockdowns to actually take stock because their agreements required them to continue taking stock from their suppliers. Those companies that held off are now finding it very, very hard to restock. And so they may suffer a little bit more than the companies that were suffering during the lockdowns.
We can get specific in terms of results being better than expected. Were there any companies that really caught your eye in terms of shooting the lights out and just blowing past what the market expected of them?
Yeah, Aristocrat was an example of a company that just surprised everybody with respect to its outlook as well as its results. We took advantage of Aristocrat when its price was probably reflecting a little bit of indifference, I guess, with respect to its prospects. But that company is only on the cusp of really reopening and recommissioning its machines. It's selling more. Its on-land sales are increasing at a rapid rate. And it really is leveraged, it seems, more operationally to a reopening than what many analysts actually thought. On the downside, the banks probably disappointed a little bit more than expected, and only because, for example, Westpac got hit with another investigation, and the banks probably had reflected a little bit more optimism about their prospects. Their price was probably a little bit ahead of where their prospects were. And I remember talking to you last time, I think, about the banks. They looked pretty cheap back then, but more recently they weren't. And so, if companies aren't going to continue to shoot the lights out, then in this environment where people are nervous about inflation, you're going to see the share prices come off.
So another talking point from AGM season, Roger, has been around margins, and we've seen a lot of businesses sort of suffer from higher input costs and those sorts of things. So what's been your key takeaway on that front?
Yeah, so what we've noticed is a couple of things. I mean, for a lot of businesses, wages are the biggest issue. And while some businesses aren't experiencing higher wages right now, there is an expectation that wage claims might continue to rise. Now, as I said to you in our previous interview, there is, I believe, no reason to worry about sustained or persistent wage increases. I do believe that will all be relieved by a reopening of international borders and a resumption of international immigration. The other one is the supply chain bottlenecks. Whether you're in construction or retail, or selling vehicles. It doesn't matter whether it was clothing, bicycles, or semiconductor memory chips. There has been a shortage of supply of just about everything, and that's a function of the fact that everyone was caught short in the supply chain with the rapid increase of demand that would occur as a result of online shopping while people were locked down. But capitalism has, a really wonderful way of actually responding to higher prices. It starts to supply more, and that's going to happen. And we're already seeing, for example, we're seeing the freight index. We're seeing that bulk freight index starting to come off. It's fallen about 40 or 50% just in the recent month or so. We know that commodity prices are starting to fall as well. And so all the things that the media is talking about companies need to be worried about in terms of cost pressures and the pressure on margins, all of those pressures have already started to be relieved. They're already starting to come off. Even as the media reports that they're a problem, they're already in the past. And so I think for a lot of businesses that have reported supply chain issues that have caused margins to contract or for margins to be under pressure, we think we're going to see those things stabilise, if not reverse.
The cure to high prices is high prices, and it's good to see some of that starting to come through. Roger, if we can get specific, are there any companies that you think the market punished for worse than expected margins, but you think that they'll surprise on the upside in future quarters? You think the margin pressure that they reported was more transitory than structural?
Yeah, I think retailers in Australia that were selling overseas, I think there was an assumption by the market that they would suffer from the sorts of issues that you're alluding to. So businesses like Lovisa, City Chic, they've shot the lights out. The market didn't expect them to do as well as they're doing, and they're going to continue to do very well as they replicate their success in Australia overseas.
Speaking of retailers, Roger, the third sort of takeaway from the AGM is around the retail sector and its start to FY22. So what has been your kind of key takeaway from that?
Yeah, look, I actually think there's one of these I call it a feedback loop, and what happens is I'll come on this program and start talking about inflation concerns, and there'll be a few CEOs that are watching the program. Then that sort of feeds into their thinking, and then they start to talk about inflation concerns or whatever the concern might be that I raise, and then they project that to shareholders and people listening to their call, and I'll be listening to that call, and then I'll say, oh, that confirms what I said earlier, but they were listening to me. And you get these, and I'm not suggesting that that's actually happening, but you do get these feedback loops that aren't necessarily relevant. So we've got to read through that. It's much easier to predict the longer term than it is to predict the short term. And I think so where retailers and not necessarily just retailers, but other businesses, where they've been cautious about FY22, I think in many instances they'll be overly cautious. The one thing that I think that we need to keep an eye on with respect to commentary around FY22 is just how much of the $200 billion in accumulated savings that has been amassed during the lockdowns by consumers in Australia, just how much of that is spent. So there's plenty of savings, and a lot of people are hopeful, and there's been a little bit of optimism in the AGM season that that's going to be spent over Christmas. And remember, the outlook for the Christmas season is pretty promising because lockdowns have ended just in time for the Christmas season. But there is a possibility that the economics of enough start to play into that future spending. And so irrespective of what CEOs are saying about FY22, we just need to start thinking about, well, okay, people have saved $200 billion. They're going to spend it at Christmas, but how much are they going to spend when they've already bought most of the stuff that they wanted and needed during the last 2 years of lockdowns and during the last 2 years of the pandemic? So I call that the economics of enough. And so irrespective of what CEOs are saying, I'm rather more interested in seeing how consumers behave. And so we're really keeping an eye on businesses that have been unduly pessimistic, and that's helped the share price fall. Because if people are continuing to spend, that'll be pretty positive. But where the market is super optimistic, well, we've just got to keep an eye on the possibility that the economics of enough play. But as I mentioned before with Lovisa and City Chic, we think those businesses are fairly uniquely positioned, not only for a reopening here in Australia, but also from the growth of their store footprints overseas. And, there are other businesses in Australia like Rebel Sports, for example, not Rebel, sorry, Super Retail Group, which owns Rebel. We think they're in a terrific position because they're positioned for a reopening, but they're also positioned ideally for domestic travel and domestic outdoor experiences. We think they'll do better than, for example, JB Hi-Fi, which really benefits from people buying technology to entertain themselves while they're at home. People are going to start going out more, they're going to travel interstate more, and so that's going to benefit those companies that are positioned to sell products that service that demand.
So Roger, some interesting takeaways there from earnings season and AGM season. Overall results have been better than expected, but margins have been coming under pressure in some areas, and that retail has experienced a subdued start to FY22. But was there anything else that caught your eye, or any recurring themes that you heard coming from the mouths of CEOs and CFOs over the last few months?
Well, we think industrial property and the sort of mobile home housing, or the businesses like Ingenia and Goodman Group. We think those businesses have really, I think, surprised the market with just the level of demand for their particular product. So in the case of Goodman Group, they're the largest listed player in Australia with respect to warehouses and logistics type real estate. And of course, because of that massive step up, which I, by the way, think is a permanent shift in the acceptance of online spending, their assets are uniquely positioned, not just in Australia, but globally, to take advantage of that increase in permanent plateau, I think, in demand for online spending and the need for logistics and warehouses. And then a business like Ingenia, they're benefiting enormously from record prices in real estate that are being paid for these what used to be seen as sort of low-priced housing. People are downsizing, living in community near the beach, and tree changes and sea changes. And this is a business that's doing much, much better than the market expected.
Two really interesting stocks there, Roger, and that's a great way to finish, because we do have View tomorrow to go through 3 or 4 stocks that are on your watch list. So unfortunately, we have run out of time again, but it's been a pleasure as always, and we'll pick it up again tomorrow with Watchlist Wednesday.
See you tomorrow, Bryce. See you, Ren.
So that brings us to the end of our episode today on Equity Mates. But as you just heard, we're back with Roger again for Watchlist Wednesday. So again, stick with us, and we'll see you tomorrow.